I actually had a 1031 where we were less than a week away from closing, and the lender came back and said, yeah, we're not going to do a 1031. I'm like, are you kidding me? Like, now it's too late for me. I can't pull out of this. So it was basically a broken 1031. I had to pay like $100,000 of tax that I didn't want to pay. I had it all set, ready to 1031. There's commercial real estate loans or loan maturities. It's like $1 trillion in 2025 that matured, and that's going to peak. So there'll be another over a trillion in this year, 1.5 trillion next year in 2027 of maturities. So if rates don't go down, people are forced to refi.
Today, we're joined by Steeve Breton, president of Velocity Capital, a multifamily owner, operator, and fund manager based in Boston. Since launching Velocity Capital in 2017, Steeve and his team have invested over $500 million in assets, worked with hundreds of investors, and navigated everything from high interest rate environments to opportunity zone development and preferred equity structures. Today, we're talking market cycles, blind spots investors are missing, tax strategies as ROI leverage, and how to position capital for what's coming next, because there's a lot coming next. Steeve, thank you so much for joining us. Tell us how you got into what you're doing today and specifically what you specialize in.
Thanks for having us or having me on the podcast today. Always a pleasure to share kind of our background, where we've been and what we're seeing in the market. I started with buying small duplexes in the Boston area where I live. That was in 2012. That quickly turned into a sizable portfolio that I was trying to manage while still having a full-time job. In 2017, I had enough friends and family that wanted to invest alongside of us because they'd seen how great real estate was for our portfolio and our net worth and little extra spending cash. And so they wanted to get involved, but they didn't want to do any of the work, right? The tenants and toilets part that nobody really wants to have. So I started looking for larger properties. I launched Velocity Capital early in 2017, and we jumped into a 105 unit property in San Antonio, Texas. That was our first value add. And since then, we've done 24 of those, all in between 80 and 340 units, I think is our largest. And we've exited more than half of those. So we've gone full cycle with renovations and then selling the property. It's been a heck of a ride. And I would say that the first several years, so from 2017 through COVID, it was amazing. 2 or 3 years in, we're doubling investor money. Like, it was just too easy. So every time somebody was like, wow, you did an amazing job, I'm like, the market did an amazing job. I just did what I was supposed to do. And I executed a business plan. But I also learned a ton during that time. But these last few years have been much more difficult and learning a lot more now.
Wow. I mean, you've been through so many different cycles and different types of markets. Tell us what feels different about this one.
I mean, we could start with maybe a little bit of history. COVID was actually pretty good for real estate. Like, I panicked when it hit, and then it was like, oh, things aren't actually so bad here. And the Fed had cut interest rates down to zero, which helped us a lot as well. There wasn't a lot of issues with getting people to do work or the cost of renovations or anything like that. But inflation did eventually rear its ugly head. And by 2022, I think it was, early 2022, the Fed began aggressively raising interest rates, right? 5% in a year, which is faster and higher than they've ever gone. I guess the speed was faster. They, at one point in the 80s, they were up to 18%. That was absolutely an anomaly, and it was fairly short-lived. But we've been stuck here at 5%. So that did tamper inflation, which is great. That's what the Fed's job was, right? One of their jobs. And it also stopped a lot of real estate building, so multifamily building. So the impact there was twofold. One, you can't refinance at 5% higher than what you went into. So if you had a property on a variable rate loan, which a lot of us do when we're doing like a fix and flip, or even a value add on 100 units is the same as doing a fix and flip. It's just you're flipping 100 units all at once. It might take you a year or two, and a lot of times you're on a variable rate loan, and then you've added so much value that you can cash out refi. That was the plan for many, many years. But when the Fed raises interest rates by 5% and you're already in that property and you go to refi, they say it's $1 million cash in refi, which is a very different story. Or it's even more than that. And then you're handing back the keys or whatever it is. It definitely caused some distress in the market for sure. Inflation also, I should say the Fed tampered inflation by raising rates. They just stopped it from going any further. But we're never going back to the prices, the cost that it used to be to paint an apartment unit or change out the countertops or whatever. Even the rates that you're paying to property management for their on-site staff, those things are never going back to where they were. So the past couple of years, it's been about, aggressively managing expenses. If you're not really dialed in on your expenses and understanding how to manage your property on a day-to-day basis, how to figure out whether or not it's worth doing a capital expense, upgrading units, or whatever it is, you're going to end up losing money and potentially losing the property. And I think it's going to be like that for another year or two. We all had high hopes that we'd be dropping interest rates by now, and the Fed has just held fast. A lot of that is probably to do with Donald Trump and them butting heads, and whether you like him or not, it would be really nice if he just stopped talking so that the market could have some more certainty and reduce their rates. And I don't know if those will come down next year, but we're all hoping that they come down a bit and things loosen up a little and it's a bit easier to do business.
How have you changed your internal operating procedures in order to mitigate that risk and to overcome like the challenges? I know you mentioned that you kind of have paused on, is it acquiring new properties, and you're just really tight with how you manage capital. What does that look like internally, and how like can our audience take away what they can also do in order to float until things kind of improve and get better?
Yeah. It was survive to 25 is what we heard a lot last couple of years. And it's like, okay, we're beyond 2025 and we're still just trying to survive here. It's crazy.
Right.
So yeah, a couple pieces on that. So on the operations side, day to day, we're in touch with our property management companies far more than we've ever been, like literally reviewing every expense. We don't just assume they're doing a good job anymore, which because it was easy for them to do a good job in the past, now it's much more difficult. So we have to manage literally every expense at a very close level of detail. CapEx expenses, again, we're asking for multiple bids. We used to do that in the past, but it was a little bit more loose. And now it's like we want to see 3 bids from 3 different competitors. And if that same thing gets bid again 6 months later, I want a different 3 competitors. And let's just get a real sense of that market of who's who and who does quality work and all that sort of thing. So that's been a lot of it. We have a couple of properties that are basically at break even with all the expenses. And we've had insurance also went up a lot in the last couple of years. Taxes have gone up a lot, especially in the sunshine states. So it's been literally brutal to manage these properties to do a good job, especially when you're at a place where you're basically at break even. The good news, that's in Houston, by the way, that one particular property. With the Fed raising interest rates so much, the new construction has fallen off a cliff. So in those Sunbelt markets where rents were growing by 5 or 8% year over year for many years, finally, when the overbuilding, well, I should say that caused overbuilding because all the developers rushed into those markets, and then the Fed raised rates and that building fell off a cliff. So the last of those, it takes about 18 to 24 months for all that stuff to be worked through the system and for them to finish the construction. So those have finally been delivered for the most part, and we're seeing rents now finally starting to creep up a little bit. So we're hoping that this spring will be a great leasing season and help us get to the point where we're catching up to some of those additional expenses from all the inflation. And then on the CapEx side, we have gotten into a couple of new deals. There was some renovation on one of them on a lot of units. Again, we're super careful on our underwriting about, okay, if we put in washer dryers in a closet that backs up to a bathroom, right? That's a typical kind of a value add. How much money are we really getting in this market? And we used to just assume we're going to do really well because other properties that we've done got a lot of money for that sort of reno. And now we're doing rent comps. We're walking those rent comps, much more careful about, are we really going to make this money back in this environment, especially, right? Because again, if the cost of everything has gone up, that means our tenants are also suffering with all this inflation impact. So, are they really willing to pay at this point? Or are they kind of tight in saying, I'm just going to move to an apartment somewhere that doesn't have washer dryers because they can't afford it, right? So it's just having to be extra cautious, and you can't rely on past experience with what renovations worked or didn't work.
So now you're building in kind of that SOP within your business to take apart the CapEx and understand what maps to ROI. Is that right?
For sure. And we also hired an asset manager who is extremely experienced in operations. And he's got, I was pretty good at it, but I realized this is going to kill me for the next, if I have to keep doing this at this level of detail on my own. I had a couple of other people on our team, but I was really the one managing the assets at that level. So I brought him in and he's been extremely good. He's from the military, so SOPs are definitely his thing. He assumes that nothing is ever going to go well because, his background is if somebody makes a mistake, people get killed. So he's like, I'm going to make sure everything is perfect all the time. Which has been a blessing. So it allows me to focus on other parts of my business, and he makes sure our assets are operating as best they can.
Like a well-oiled machine.
Yeah, yep, exactly.
So what specifically, is there anything that we can take away from what he's done in your business that will help our audience understand what they can do in theirs in terms of how to brutally look at CapEx? I mean, that's something that we're doing for operators CapEx is tied to any kind of renovation. It's not just design, right? I don't like the word design. I think I'm like, don't equate me with that. Yes, design is awesome, but it's really about anytime you update a property, anytime you're about to spend on whether it's washer and dryer or some sort of additional amenity or something that could add value to the property, we have to understand how does that map to ROI. So I'm curious what he's doing and what he's found, what he's uncovered within your operations that have given you guys insights and clarity on what to invest in and what not to.
So number one, I'm not on those calls on a day-to-day basis anymore, which is fantastic. But I have gotten calls from some of the property managers that I used to deal with on a day-to-day basis, and they're like, "Danny's really aggressive. And I'm like, tell me more." They explain what's going on. I'm like, it sounds like he's just really holding you accountable. Like if you actually had done that thing, he wouldn't be so tough on you, right? If you had managed those expenses more closely or done, it's not just expenses either. It's, part of it's on leasing, right? Are you aggressively pushing leasing? Are you negotiating with your tenants that are up for renewal? All of those things have to happen. But yeah, I don't, other than what I already said about, managing like literally every expense super carefully and reviewing everything and not just taking your eyes off the ball with the property management company, there isn't anything specifically there from day-to-day operations. On our new builds, so we'll build Class A properties when we do construction. And in those, a lot of times we'll do like key fobs on the doors, which is sort of extra, like very extra. Like you don't really need that. That's kind of a luxury thing. But today we're not even going to bother, right? So we have 2 properties under construction right now, and we're not doing the key fobs because it just doesn't make sense to try to push rents and and have people feel like, okay, this is a super luxurious unit, but the market doesn't demand luxury rents right now.
Right. Okay. And what are you seeing in terms of comps for A-class properties, the types of amenities that you should invest in?
I'm actually on the other end of that spectrum. I'm like, I'm not putting anything extra, right? So
right.
The properties that we're building, we've gone a bit lighter on amenities. There's a gym, but maybe you don't equip the gym with like everything that you normally would. You could always add it, right? So this gym's a little bit more spacious right now than usual. Maybe you skip the sauna. A dog wash station's fairly inexpensive, so you put that in, right? Depending on how big the property is. So and then like fobs and sort of the digital thermostats, the ones you can control on your phone. It's like that's a lot of additional expense that probably isn't necessary right now.
Right, and that could be
you can
changed
also
out.
retrofit. Yeah,
exactly. You could change that out later. Are
right.
you seeing that's across the board with your comps as well? Or are you more aggressive in terms of cutting expenses?
We're probably a little bit more aggressive, at least on the 2 properties I'm thinking of right now. And part of that, again, is because the market's, occupancy's been a bit more difficult. So to try to maintain that 92, 93% occupancy, you've got to undercut your competitors a little bit. And so doing a bit less of that CapEx and showing your potential residents that, this is sort of a value compared to the competitors, right? Do you really need the massive gym with every bit of equipment? And do you really need that thermostat or whatever it is? So if we can cut those things back a little bit and we're like, look, the unit itself is exactly the same as the comp, roughly the same size, but we've saved some money by not charging you for all of these additional things. Even our internet billing, we do chargebacks. We'll do a master plan for internet and then we charge it back. We're charging back at, a bit lower than our competitors, again, just to kind of differentiate and have people want to come live at our property so that we can keep that occupancy high.
And do you see that? Do you see that the occupancy is high? Or do you still see that, especially for Class A luxury rentals, people are willing to spend more for the amenities?
We're better occupied than most of our competitors in at least 3 markets. The 3 that are kind of offhand for us. So Indianapolis, Houston, we have an asset in San Antonio and Wilmington, North Carolina. But yeah, we tend to be higher occupied. El Paso is another market where we're higher occupied than our competitors. We're having to give up a little bit of revenue to do that, but I'd rather do it in these ways than to just reduce rents.
Wow.
The other way would be to reduce rents a good amount to try to draw people in that way. But if you have the reduced rents and you've spent less on CapEx, it's a little bit easier to swallow.
Do you find that when you reduce the rents that you're still attracting a high level of tenant as well?
Yeah, absolutely. In these higher market or higher class properties, like an A class, it tends to be kind of the same tenants anyway, for the most part, that can afford that luxury unit, or maybe not luxury, but Class A. Yeah.
So your ROI is bigger in terms of the occupancy than it would be for increasing the rents a little bit with a higher amenities. Is that correct?
Yeah. I mean, again, you need a good spreadsheet or some kind of a tool to justify that ROI, right? So how much money do you put in? How much rent are you going to get? So, if you've got those tools and you know how to use them properly, then you can kind of figure out the right balance.
Yeah, absolutely. I feel I've seen that a lot of investors will not get down to that granular level because, like you said, it kills them. All right. Mm-hmm. It's so challenging. It's so nitty gritty to know what's going to work, what's not. For so many, it's just a gamble. Right. I hope it's built on hopes and dreams. And we have all this data on everything else. But I found personally that there is no data set, there's no underwriting for the nitty gritty of, will this specific renovation amenity detail, thermostat, whatever it is, will that drive an ROI? And the way that we do it, just to give our audience and everyone listening behind the scenes, is really the reviews, right? Look at the competitors, look at the comps. The reviews tell you everything that the market needs to know. There's never going to be somebody with a crystal ball that's going to be, even with all the experience, the 18 years of experience that I have, you still never know, especially for that specific market. It's better that the market should tell you what they want and what they're willing to spend more for. You look at the negative reviews and you say, this is what they're not doing right. There's a gap in the market. Let me fill that gap and deliver a higher, and then you know how to position your marketing. The marketing is cheaper. It's easier to fill an occupancy and get the rents that you want.
But everything you're saying is a lot of hard work, right?
It is.
People, especially if like the newer syndicators that got into this business in, the late teens or 2020, or, they just haven't been through it enough to understand that these things are super important and that it's really hard work, because all the gurus out there told them it was going to be easy.
Right, exactly. Which is why we do that hard work for them. Yeah, exactly.
And a lot fewer syndicators now than there were a few years ago.
Right. And ultimately, the question is, okay, well, do you want to put in that hard work that will then pay off for an exit, right? That will increase the NOI, or you don't. And you just want to, do the hard work in a different way, with costs being high, with margins being thin. Because if you don't put that work up front and you have to later value engineer or say, oh my gosh, I made a mistake on doing this, this upgrade when I shouldn't have, and I could have taken that money and invested it, reallocated it to something else that would have allowed me to increase, rents or occupancy. That's when it's like, which one would you rather?
Well, that's when you're looking at potentially losing investors' money, or again, you're trying to do a cash out refi and it's even more money that you have to put in because you're not getting the rents that you thought you were going to get, and you spent too much money, and that actually dovetails into the other side of our business, which is our preferred equity fund. So we do partner with other operators, people that might own a property in a different state. And we used to do sort of a 50-50 partnership, and we'd raise the money and do some of the asset management, maybe handle all the legal or investor relations, whatever it is, depending on who that partner was. And most of those went really well. And I stayed fairly heavily involved in a lot of those anyway, but there were a couple that just didn't go great. And the person that I was working with thought that they knew better, even though they were less experienced, and they wanted to do things a certain way. And more recently, in end of 2024, we launched our preferred equity fund, and we said, okay, if you want to partner with us now, we're going to come in as it's going to be a JV partnership, and that JV operating agreement, joint venture operating agreement, will be very detailed in the sort of decision rights that each party has. And so, okay, that property's in your market, you probably know better, and you seem like a great person, and the deal is amazing, so I do want to work together, but you can't fire the property management company without getting permission. You can't move to self-management all of a sudden because you think you're now a property manager. If you've never done that, you don't have that sort of experience. Or if we tell you it's time to fire the property management company, you have to, right? Because keeping a bad property manager on site is awful for your returns. And then the other things, refinancing and sort of encumbering the property in any way. We have all those decision rights. And if they don't follow the operating agreement exactly as planned, we can just step right in and take over that property. And we are underwritten by the banks on those properties as well. So the banks are like, yeah, if this property starts going sideways, we would love for you to step in and take it over. Right? They're more than happy to
You have the track record. Yes.
Exactly. Yeah. So that's worked out really well for us. And for that level of control, we give up a little bit. So in a preferred equity position, we're right behind the bank, but we're ahead of all of the other investors. That's probably the most important part. So the common equity, my partner might be raising 10 million total. They bring 8 million of common equity. We might bring only 2 million of preferred equity. And if something goes wrong with that property, the 8 million of common equity has to get completely wiped out before we have any effect on our deal, right? So our money comes out first as far as being paid back first. But again, for that sort of security, we have to give up some returns. So that deal might produce a 17, 18% return. And maybe my partner thinks it's going to be a 20% return. I'm like, great. I really hope it is. But we're going to get the first 16% on our 2 million. Right. So on a much smaller piece, we're going to get our full 16% before you get a penny. And then we're out. So if it earns 20%, that's more like 22, 24% for your investors. So it does juice the returns for them, but it does cut both ways. So if that deal does not go well, we're not the ones that suffer for it.
I love that. Tell us the difference between preferred and common equity and who should be doing one versus the other.
So from a investor standpoint, if you're coming into a deal or if you're looking to invest in real estate passively, if you go into the common equity position, it's a little bit of swinging for the fences because you're hoping to get that higher return, 18%, 20%, whatever it is. You better be in there with a really good operator with tons of track record to make sure that you're going to not lose your money and hopefully earn that higher return. And a lot of our investors are older, they're retired, they want cash flow, and they want to ensure that they're not losing their equity. So in that case, they're better off probably coming into a preferred equity fund like ours, where they're in a position that's protected, right? All of that other capital, the common equity, is behind their equity. So they get their money back first. They get their first 6% of returns or cash flows before the other folks do. From a operator perspective, again, you have to really believe in your property, right? It's kind of a litmus test for us too. Like if you're willing to work with us, you must be really sure that this thing's going to kill it in your market. And we tell them very carefully, like, here's exactly what's going to happen if things don't work out. So all of those underwriting assumptions you made, go look at all of them again. Go study your market again. Let's make sure. And we do the same thing. We'll jump into that market with them and we'll review all of their underwriting, all of their assumptions. We'll do our own rent comps, and we're just trying to figure out where are we really going to land on this thing. And if it's anywhere close to what they think it's going to be, then we know we're going to be okay.
Do you think that in this specific market, properties can still perform well and still make a lot of money, or is it, like you had mentioned in the beginning, just breaking even?
On the development side, we're doing really well, but there's certain things there too, like we get municipal bonds, so that it's like a public-private partnership with the city. We're also getting a lot of tax abatements. So if you can get those things, then the deals pencil really well. And we've got a couple that just finished construction that are leased up, and we're looking to refi now, and it's going to be like half of our investor money out on the refi. So it's pretty amazing if you can find those deals. It's not easy to find. On a simple like value add kind of C-class deal, much more difficult these days. So you pretty much have to find it off market. It was hard enough to make things pencil that were coming through a broker a few years ago. Much more difficult now.
So how do investors that are still investing in those properties, how do they navigate? Do they just sit it out and wait? Is there anything that they can do in order to, like if I was going to go out and buy a multifamily tomorrow, what would your advice be?
It's tough because I did sit it out for quite a while, right? We launched that fund because we were like, we're not comfortable going into a deal with common equity right now because it's such a tight market. So I think sitting out is probably the right move unless you're really experienced and you're comfortable with all the things we talked about earlier as far as like managing the property in like great detail, managing those expenses and understanding what value add components you're really going to put into the property. Otherwise, sit it out for a while. I'm hoping that in the next 6 to 12 months, interest rates drop a lot. That's going to help a lot because then the people that are currently holding properties, they don't want to sell it at this prices right now. But also, when interest rates drop, they should be able to sell at a higher price. And there's a balance there as well, because if you're buying it with that lower interest rate, it's going to cash flow better. So it's just a matter of like, you can't let that price rise too much because then you're still in the same position. But hopefully things balance out a bit more and it makes it easier for people to acquire an asset. And we're also hoping that that's going to shake some assets loose that people are selling on the sales side, because we love people that have 1031 money. People just don't want to pay their taxes on those big gains. And we do a lot of opportunity zone investing. Yeah. So with an opportunity zone property, so in 2017, the tax laws came out for opportunity zones to allow investors to go into markets where, like, if there's a blighted area in a particular city, and it didn't even have to be blight or really a bad neighborhood. Sometimes they were actually pretty decent neighborhoods, but they were the lowest or lower income of those cities. And so if you were to invest your capital gains, so if you sold a property or Bitcoin or stocks or whatever, any capital gain at all, invest that money into one of these properties, then you get to defer your taxes for 10 years on that capital gain that you just had. You also pay no tax when you exit the property that you just went into in that opportunity zone property. And then if you had a 1031 to begin with, so a lot of people have like a 1031 that they rolled over 10 years ago, and then they rolled it over again 5 years ago, and they rolled it over again when they're selling this property. So they have this massive amount of money stuck in it. When you do a 1031 rollover, you have to roll over all of the money from the sale, including your initial principal, all the way along. So when you do an opportunity zone project, you can take that entire 1031 sale, pull out your initial principal and go and use that on like lifestyle or buy a house or whatever, or invest it in a different way. But you can then take your capital gains and put those into an opportunity zone deal or into an opportunity zone fund or multiple deals. By doing that, you get to keep your initial principal as well, rather than in a 1031. It's almost like you have no benefit, like you're accruing your net worth because the value of that 1031 keeps growing, but you can't touch it. So
Right.
it's nice to be able to move into an opportunity zone and have that benefit.
Right. It keeps growing and you're deferring the inevitable.
Yeah, right. Yeah. Eventually you have to pay taxes on your 1031.
Right. Right.
With this opportunity zone deal, because you're not paying taxes on the OZ deal that you went into, right? So you have to hold it for 10 years. That's the only issue, which is, not an issue for me because I'm a long-term holder, or I try to be. But if we go into an opportunity zone deal and you're not paying taxes at the end, that 1031 tax that you would have paid, and you still have to pay that 1031 tax at the end, but you're not paying tax on this one. So it kind of resets you, it gives you the ability to reset and say, okay, do I really need to keep 1031ing, and a lot of times people think, well, I'm just going to 1031 until I die and then give the asset to my kids and they get the stepped up cost basis and they won't have to pay the taxes, which is wonderful, but is it worth it? Right? Is it worth trying to find a new asset to do a 1031 into, which isn't easy? The timing's difficult. Are you going to do that for another 20 years and hope that you don't screw it up along the way? Or have I actually had a 1031 where we were about to close. We were less than a week away from closing, and the lender came back and said, yeah, we're not going to do a 1031 because there's one guy on loan committee who's had a bad experience once with a 1031. And I'm like, are you kidding me? Now it's too late for me. I can't pull out of this. So it was basically a broken 1031. I had to pay like $100,000 of tax that I didn't want to pay. I had it all set ready to 1031.
Wow.
So,
Wow.
Yeah. So, it does happen where it gets broken and then you end up paying your taxes. So again, that's a lot of stress to carry for 15 plus years.
Right, exactly. I think it'll give most people gray hairs if they don't have already. Are there a lot of opportunity zone deals still happening, or is that something that you're still involved with?
Yeah, so we've had 2 of them. That's one of the builds that we're just completing now as well. So we're just starting the lease up process. That one's like an hour away from me. And then we have another parcel nearby. So that's Manchester, New Hampshire. So there's another parcel in the same opportunity zone that our developer friend up there has his hooks into. So, he's been talking to those owners and has put some money down. So if we develop those parcels, that'll be another opportunity zone project kind of middle of this year. So again, that's part of the reason why I'm hoping some of these properties shake loose here soon so that people have those funds coming out of a deal that they want to move into another opportunity zone deal.
What would you recommend for an investor that's looking to do, is that the opportunity zone that would be worth it, that would pull somebody off the sidelines to do?
Oh, so if you're an investor, not an investor per se, like a passive investor, but if you're an operator, you're trying to buy a property and operate it, opportunity deals are very difficult. So they're hard to find. If you're buying something that's just being listed, again, that's going to be very difficult. It's like anything else, right? It's being marketed, so it's going to get top dollar, and then it's not going to be worth doing because the person who pays the top dollar is probably paying too much. The person who really knows that market inside and out is the guy who has built 10 properties in that same little town. They live right there. They know every bit of the process of how to work with the city and what everything's going to cost. And they're underbidding you by hundreds of thousands or $1 million. That's probably the right price. So it's so difficult to win those. So it makes sense, again, if you have somebody, a contact who's got a bead on that land, who can get the land at a good price. Like anything else, it has to be the right value. So you better be very good at underwriting.
Yeah. And it's all about network.
Yeah. I never realized how much it was about networking. It took me a few years to really understand that. But by the time, COVID hit or so I guess that's 5+ years ago, I really understood it. And it's been nothing but networking since.
Yes, absolutely. Last couple questions for you. Do you feel that most operators overinvest in terms of renovations and upgrades?
I've seen it, right? So one of the deals that I was involved with a partner, they continued to invest even when this market got super tight. That's 290 unit property. They were still doing renovations after interest rates went up and after inflation. And so the renovations were costing more. The tenants in the market didn't necessarily have the money to spend more. And I was like, why are we still doing renovations? Or why are we renovating to this level? On the next 5 turns or 10 turns, let's just do basic paint and clean the carpets or whatever. Let's not rip out the carpets, put in LVT and redo the countertops and all the other things we were doing and see what kind of rents we get. And it turned out we were getting roughly the same rents. It's like, so why are we putting any money into CapEx right now? Let's wait for the economy to turn around a bit, and maybe we just leave it for a value add for the next guy, right? So whoever comes to buy that property later sees a huge upside because we've only renovated a third of the units or half the units instead of all of them.
So if interest rates do drop, 27 and 8 and all of that, or even this year, hopefully.
Yes.
Yes. What happens next? Who wins? Who gets wiped out? What does that crystal ball moment, what does that look like next?
So when rates drop, no one's getting wiped out. The only question is, can people continue to survive in this economy? And there's, I didn't mention earlier, but there's commercial real estate loans or loan maturities. It's like we're just shy of $1 trillion in 2025 that matured. And that's going to peak. So there'll be another, over $1 million in this year, not $1 million, sorry, trillion, 1.5 trillion next year in 2027 of maturities. So if rates don't go down, people are forced to refi. Like they don't have any choice. So that's more capital calls on their investors, more GPs, but hopefully they have some money to put in addition to the capital calls. But if they can't meet those capital calls, then the bank is going to end up taking that property, or they're going to be forced to sell, right? It'll be a fire sale, and maybe the investors lose half their money, right? The common equity investors. So those things are, it's still a very real threat for the next year or two, unless rates drop substantially.
Everybody's kind of just holding their breath.
Yeah. Who wins is whoever, again, can manage those properties in great detail, manage the expenses, and make smart decisions while we try to work our way through this over the next couple of years. And when rates come down, I don't know. I think I might stick to my preferred equity fund, and we'll just feel that much more comfortable in those deals because the deals should pencil a lot better.
Amazing. So what does the next, hopefully the interest rates come down and everything, stabilizes. What are the next 3, 5, 10 years look like for you?
For me, so I already have one of my sons working in my business. He was a commercial mortgage broker for a couple of years out of college, went to school for commercial finance. So he does an amazing job on everything to do with underwriting, lending, and we actually broker loans for other operators as well, which gives us a lot of deal flow. So it's a nice addition to the business. My other son is graduating college, also heavily, business, finance, real estate. He's already worked with us a ton. He's done a couple of internships at a private equity shop. So he'll be joining us after he does his 2 years as an asset manager for this private equity firm. So he'll learn a ton as well and hopefully grow our business there. And yeah, we'll just continue to do this preferred equity fund. I don't know, 5 years from now, hopefully we're on like fund 3 or fund 4. And we've worked out all the kinks already on our funds. So now they're operating very smoothly. And then we'll continue to work opportunity zone deals. So I'd like to have, another couple of those under our belt in the next couple of years.
Amazing. Thank you so much, Steve, for all your insights, your wisdom to help our audience learn how to navigate this crazy market. Yeah. And I can't wait to see what you do next. If our audience wants to reach out to you, if they want to connect, how can they do that?
Yep. So the name of the firm is Velocity Capital, and our website is velocitycap.com.
Amazing. Thank you so much. And we'll see you on the next one.
Yeah, pleasure. Thank you.